Let's also talk about the IT space that's also in focus. It has been showing us momentum of late already, coming out of its long-term underperformance for some time now. But now the fresh trigger is coming in from the US by way of Accenture Q1 results, and therefore the IT stocks are back in focus. For Q1, Accenture has posted its revenue that's up by 6% to $18.7 billion. This is a year-on-year 6% increase. They have retained FY26 sales forecast as well, adjusted the earnings per share of $3.94, beating the estimate of $3.72 as well. Now, the organic growth guidance for FY26, again, they have maintained at 0.5 to 3.5%. The advanced AI bookings is also up by 76% on a year-on-year basis at $2.2 billion. Their new bookings stand at $20.9 billion. They've already clocked in 33 large deals, and the company will discontinue the separate AI metrics disclosure. Now, the advanced AI is now embedded across nearly all client engagements is what they've also pointed out as well. Now, of course, Jefferies on Accenture has given a steady guidance, given the IT upside. They've also talked about discretionary spend still weak. However, the GenAI spend not lifting the budgets at this point in time. FY27 growth risks to also to be on a consensus. PE expansion is also likely something that they are pointing out too. Let's try and understand how to read Accenture's earnings and the sentiment that's getting developed in the US, and what would that mean for the Indian IT space at large. How would you look at Accenture's earnings, and what is the guidance there for Indian IT?
So, we are quite, if you remember, we've been consistently bearish on the IT space over the last couple of years. And a little bit of good performance that is coming in is that Accenture has guided very strongly. And, TC has done its disclosures on AI, which are a little around $1.5 billion. So that's very positive news for the sector. However, we are not getting extremely excited about this because, we would want to see how the rupee moves vis-a-vis the US markets. We think that, we continue to see a lot of negatives around that. And if you see the, the way the stocks of the big bank have been performing, if you take one of the stocks which has really collapsed, there seems to be a little bit of concern around the AI boom, which is, clearly looking to be a little stretched. And there are a lot of concerns around that. So we would want to, review the performance at least for another quarter. And as I keep mentioning that, Indian growth story from the manufacturing side is very, very strong. Numbers still continue to rule very encouragingly. And hence, we continue to remain, overweight on domestic manufacturing and still underweight on Indian IT stocks.
Okay, let me also highlight for all our viewers what Morgan Stanley has come out with a report on HCL Tech. They maintain an equal weight rating, a target price of 1680. They do believe that HCL Tech acquiring HP Telecom Services assets, the deal size is capped at $160 million. It includes the incentives. The financial impact seen is limited of this, and the acquisition unlikely to alter any near-term outlook is what they have said. That's the latest report that's come in. But in case you have to look at the IT sector in terms of where you would probably be looking at the first sign of an opportunity and you would grab, will it be in the large caps or the mid caps, Vineet?
Actually, mid caps will outperform. Large caps, sheer by the sheer size and already having very, very good efficiencies, we'll not see the needle move a lot out there. What can happen is that the mid cap stocks will outperform their peers massively. And hence, if you want to be invested, I think that is the space to be.
That's the space to be.
If you like the video, do like, comment, share and subscribe.